Third quarter 2023. It's done. It's in the books. What happened in the world of multifamily real estate? When we take a look at total sales volume, number of sales, price per unit, cap rate, and all the other metrics, what happened in the corridor that you own? It's important information. We're here to share it with you. Stay tuned. This is Chris German. Welcome back to the Apartment Dealer Show. This is it, our third quarter market update, all things multifamily. You're here because we have the best data. We're going to share with you what happened in the corridor of what you own, assuming you own in a corridor of which my team and I service. But number of sales, sales volume, price per unit, cap rate, GRM, rental rates, and how does 2023 stack up to 2022? Thus far, it's important to know the trajectory of the market. That's what we're here to discuss today. Now, the information that I'm going to cover is going to be within certain geographic corridors. These corridors are the corridors that my team and I represent landlords in the purchase and sale strategy of multifamily investment real estate. And those corridors are the East Los Angeles area, which consists of Boyle Heights, East LA, El Sereno. The 710-91 corridor, Bell Gardens, Commerce, Cudahy, Huntington Park, Maywood, Southgate, West San Gabriel Valley, Rosemead, San Gabriel, Temple City, East San Gabriel Valley, Azusa, Baldwin Park, Covina, El Monte, Glendora, Laverne, Monrovia, South El Monte, West Covina. The 605 corridor, Bellflower, Downey, La Puente, Montebello, Norwalk, Paramount, Pico Rivera, Whittier. The Inland Empire West, Chino, Claremont, Montclair, Ontario, Pomona, Rancho Cucamonga, Upland, and the Inland Empire East, Bloomington, Colton, Fontana, and Rialto. We're going to cover the metrics within these various corridors. You may be watching one specific video that had one corridor titled, but all the other videos are available, YouTube, via email from my team. So if you want, in other words, if you're looking for data in more than one corridor, the videos are available, but we're going to chunk it down, break it down by individual corridor. Now, we recently had our apartment owners educational luncheon, and this is a 3-hour event where I bring in professionals from the various facets of commercial real estate, everything from real estate law to real estate financing, everything in between. And myself, I go through about an hour's worth of financial data with respect to apartment sales and the market at large, and then as well as investment strategy. We're going to share with you a snippet from that event to share with you. Let's take a look at the market from 2008 to about 2019, because that's important, that segment. And then from 2020 to where we are here today. It's important to know market cycles. Now, can you necessarily predict a market cycle? If you ask Bruce Norris, he would say yes. I'm not here to predict market cycles. What I'm here to share with you is it's very clear that the market was on a certain trajectory. Then we had an anomaly in 2020, which was a saving grace to multifamily properties. And then that trajectory changed. And it's important for what we're going to discuss today in the third quarter of 2023. Let's go to that short video now. So where are we in the market? Well, painting in a broad stroke, nationwide, for all facets of commercial real estate, sales are down 64% this year compared to 2022. Here locally, and more specifically multifamily, regardless if you're talking about Los Angeles County, San Bernardino County, Orange County, sales are half of what we had last year. So what happened? Let's take a look at some history here. What you're looking at is two graphs overlaid. The line graph is price per unit. The bar graph is sales volume. So values and how much property sold in a given year. West San Gabriel Valley. Now, West San Gabriel Valley, somewhat of an anomaly. Their prices here of late have stayed strong, but the sales volume is, of course, less than half of what it was. What happened in 2020? Aside of us competing for toilet paper at the store and being locked in our homes, what happened? There was a huge injection of cash that was never supposed to exist. People were told to work from home, so then they began to look for affordability and room. So they moved from the cities to the suburbs. They drove up rents. There's COVID. We start out roommates. Maybe I don't want to do COVID with you, so now we split. There's more demand for rentals. In 2021, rental rates saw the biggest climb that we've ever seen historically. And then interest rates. Interest rates were slashed. It was the perfect timber to put on a fire that was going out to make it come back to life. The question is now, though, but those two saving graces, rental rates, interest rates, where do we stand today? Markets change. We went through the market dynamics I've shared with you. Look, 2019, market was supposed to shift. We got a saving grace. Those two saving graces, rents and rates. Strategies must adjust. I've shared a lot of strategy here at the time given. Some things to consider. Fundamentals remain. Well, rent and rates, interest rates, do they remain? Starting in October of last year, rental rates began to pull back. When I saw the first report, I thought that must be a blip on the screen. We just went through 2 years of historic gains and we're already pulling back. Every month since October of 2022, rental rates have pulled back. Nationally, they're down. Here locally, we'll say, at best, you're about flat. Vacancy is increasing. How many of you, I'd be curious, have noticed that it's taking a little bit longer to fill vacancies, a little more vacancy than usual? Yeah. Well, why is that? Well, if you take a look at like Los Angeles County, tenants are spending 50% of their discretionary income to pay the rent. And they're competing against inflation. You see how much it is to fill up your car these days? I mean, they just came out with the inflation numbers. Inflation's not going anywhere anytime soon. So rents are pulling back. One saving grace, gone. Well, interest rates. We still have interest rates, right? Well, as you probably know, interest rates have began to rise for some time now. Now we're hovering, say, 6 3/4-ish. But what does that mean? When someone says, hey, interest rates went up, that impacts property values. What are they trying to say? Follow me along here on the red bar. Let's say you have $1 million property. You're going to purchase $1 million, put 40% down. The gross income is $72,000. The expenses are $30,000. That means your net income is $42,000. Well, the cash flow based upon the interest rate of 4.5%, where we were January of last year, is $5,519. If you raise that interest rate just half a point, that's all we've done. Same income, same expenses. The cash flow just drops by 39% by taking the rate up half a point. Take it up half a point again, the cash flow just dropped 80%. Do it one more time at 6%, which is lower than where we are now. The cash flow is now negative cash flow, 121% lower than where we started. So how does that translate to value? Since it impacts the cash flow, what does that mean to value? Because they go hand in hand. Same building, same everything. Focus on cash flow here. If a buyer says, look, I went to Chris's seminar. He explained I have a target on my back. So I want income for my risk, which we should all earn, right? Income for our risk. They say, I would have earned $55.19. I still want to earn $55.19. So you have an interest rate of 4.5. You take it to 5. In order to keep the cash flow at $55.19, the building now has to sell for $957. The price just dropped by $42,850. If the rate goes to 5.5, you have to drop the price of the building to $916. That's an $83,000 change in price. And if you take the rate to 6, we're at a much different place than where we started when rates were 4.5%. And you see there, about middle of the graph there, a 4.94% cap rate. Cap rates, when I put these slides together, was January of 2022. I didn't know we were going to 6 3/4. We were in this room, and I'm telling investors, interest rates are going up. Do you have some things to consider? If you're holding, do you have a note that maybe is going to adjust? Maybe you should consider refinancing now. Nobody believed January of last year that we would be sitting at nearly 7% rates and probably climbing from here, not going down. So many of them didn't refi and now maybe wishing they had. That's the reality of the market. That is the impact that it's having. The two saving graces, the catalyst of 2020, rental rates and interest rates, they're gone. That's the reality of the market. So two saving graces to the market, the anomaly of 2020. What did we get? We got low interest rates and phony money in the market. Then that money is still plaguing us today, hence inflation and high interest rates. So the market was going to change direction 2019. So the fact that we're going through a change now should not be a surprise. It is not the end of the world. And the fact that, yes, today, as of the recording of this video, interest rates are between, say, 7 and 8%, depending on one's strength as a buyer, location of a property, and so forth. If you're comparing that against 3.5% interest rates, then I could see why you might be overly anxious about the market. But if you take a step back and compare that to a more normal average interest rate for commercial lending, say somewhere in the neighborhood of 6 to 6.5%, then you realize, yes, interest rates are up. And I'm not saying anyone wants to pay more debt than they have to or more for debt than they have to. But what I'm suggesting is that it's an unfair comparison to say, hey, today we're at 7 compared to 3.5. It's different if you say today we're at 7 versus the average of 6, different perspective. And even more importantly, I think it's dangerous for individuals to say, well, I'm out of the market unless I see interest rates of 3.5%, 4%. I don't know the likelihood of that. I'm not an economist. All I know is it took a global catastrophe to get interest rates that low. Do you want that type of global economic catastrophe once again? I don't think any of us do. So maybe those glory days are gone, and we need to work within the realm of reality that, yes, interest rates may pull back somewhat, but maybe not to the lows that we saw of 2020. Okay, now let's dig into each individual quarter. We're going to highlight the number of sales that took place in the third quarter of 2023, not for the entire year, the third quarter. We're going to highlight overall sales volume for those 3 sales. We're going to highlight price per unit, cap rate, GRM, gross rent multiplier, and price per square foot. And then we're going to take a look at, well, here's where we are today. Let's compare that to 2022. Does that tell us something about the trajectory of this specific corridor that we're discussing? The Western San Gabriel Valley. Here we're going to discuss Rosemead, San Gabriel, and Temple City. Of course, there's other cities that encompass the Western San Gabriel Valley. These are the cities that my team and I service. These are the cities that we track. In these 3 cities, there was only one sale in all of 2023. That sale was $1,750,000. Now, if we look out over the whole course of 2023, all sales, the average price per unit has been about $319,541. The average cap rate, 4.78%. GRM, gross rent multiplier, 16.79 for this one particular sale. And the price per square foot for this particular sale was $357. Now, well, what should one compare that to? Well, let's take a look at 2022. Where were we at the end of 22? Now, I recorded a video at the beginning of this year that rounded up all the data of 2022. And if you're curious as to what those analytics were, we'll put a link here and you can access that full video where we cover various corridors for the entire year. But I'll give you this synopsis here. Where were values at the end of last year? Well, the average price per unit at the end of 2022 in this corridor was $316,697. So the price per unit, well, at least on this particular sale sold slightly higher than the average of the properties of last year. The cap rate of 2022, the end of 2022, the average, if you will, for all of last year was 3.04%. That has jumped significantly to 4.78%. So what does that tell us? That tells us that while, say, values are about the same, slightly higher in this particular area, since the cap rate has grown significantly, that means landlords have raised their rents and not really had the same proportional growth and equity, right? Because cap rate, rate of return. So this tells us that the properties are being sold or offering a higher rate of return than last year, and if the prices stayed about the same, our rental income went up, but our equity didn't go up at the same time or at the same proportion. To calculate cap rate, easily said, is that if you were to purchase a property all cash, what would be your rate of return? What would be your cash on cash return buying a property all cash? But how do you act? Most times you're not going to purchase a property all cash. You're going to use leverage, some debt. So then how do you calculate it? You take a property's net operating income and divide it by the purchase price. Now, to understand how one should derive that net operating income, please do not just rely on a marketing package that a broker sends you for a current listing. Because as you may guess, sometimes the expenses they share are a little light because that raises the cap rate. So we actually have a video where we outline for you what expenses you should take into account, and we're going to put a link here. The one word of caution that I'll share is that property insurance, and here in California, has gone up significantly. It's pretty much doubled in most cases. And that's, from what I understand, going to happen across the board for single-family homes and auto policies and all the rest. So the insurance landscape is changing, so one has to keep that in mind as you're underwriting a property. But if you go to that video, you actually gain access to a spreadsheet as well, and you can build your own, and we outline for you there what expenses you should take into account to calculate cap rate. Now, the one sale that took place in this corridor in 2023 was this 5-unit in the city of San Gabriel, sold for $1,750,000, which was $350,000 per unit, about what you would anticipate given the averages that we discussed. This definitely is an outlier sale, what we would call an outlier sale. And there are outlier sales, right? Which mean above the average. How do you get above the average? Typically, you're talking about a property's condition or rental rate most times. If the property is in better condition relative to the other properties that are being offered for sale, and the income that it's collecting is higher than the average of the other properties that are being offered for sale at that time, then it's going to command a higher sales price. Now, are there times when that maybe doesn't occur? Sure. Maybe somebody was ill-informed about a property. They overestimated, they were over-optimistic about what they could do with the property. So they quote-unquote overpay for a property. That creates an outlier sale as well. You see those. Rental rates. So here I've outlined in multiple cities here, and we've included cities like Arcadia and Temple City and Monterey Park, in case you own these other cities. And we obtain this information from multiple listing services, other services that track rental rates, and we compile all that information for you so that you know exactly, well, if you have a vacancy, what can one look to collect? Now, my team and I, once a quarter, update this information. So if you go to raisemyrents.com, again, raisemyrents.com, you'll find not only the current rental rates in this particular corridor, but all the corridors that my team and I service. That's free to you, our gift. It's important because your property's value and your net cash flow, the money that you put in your pocket, is dictated by your rental rates in large part, right? And so we want to ensure you have the right information, especially in light of rent control. You want to stay on top of your rental increases. And so that information is there for you. So on the onset of this video, I shared with you, well, what has been the trajectory of multifamily values over the last 15 years or so? And we took that in two chunks to understand that the market was already cycling in 2019, was on a downward trajectory. Then we had the anomaly in 2022 and things perked up for a bit, but now we're on the other side of that. Why? Because the two saving graces to values, which were rental rates and interest rates have increased dramatically. Now I want to share with you another piece of footage from our recent Apartment Owners Educational Luncheon. We're going to now go to Gil Figueroa, who is a commercial lender. He's been in the commercial lending space for nearly 3 decades. And what's important here for you to pay attention to is how Gil is able to determine where rates are headed, how much they're going to go up. I'm sorry, they're not going down. And how he's able to determine that. And Gil has been accurate with this information now for several years at our event, sharing this information with our attendees So interest rates are the biggest impact on the market today amongst anything else. So you could bring up inflation, the economy, politics, and these all things, all this plays a part, of course. But interest rates are plaguing the market, what it's done to buyers' psychology, what it's done to the rate of return on properties. I want you to key in here because this is going to be very important.
Is refinancing now a good idea? How many of you, by raise of hands, have refinanced in the last 5 or 7 years? Okay. So chances are these loans are going to do what? Adjust. What are they going to adjust to? Well, the standard product out there now, we no longer have LIBOR. Now we have SOFR, S-O-F-R. And that index currently today is at 5.3. Most banks' margins are between 2.5% and 3%. So if we're going to adjust, we're going to go to 7.5 to 8, almost 8.5. So if you do nothing right now and don't refi now, this is your future, okay? This is where it would adjust and it's going to hurt, okay? These are realities. So this is where short-term loans are for all banks. All banks have pretty much turned over to the SOFR product, okay? So we know what your situation is coming. This is the reality of what you're doing. Do you need a game plan for the future? Absolutely. When you bought that property at 3.5 or 4% and it penciled, I guarantee you it won't pencil at 8. Okay, so you need a game plan. You need to understand what's coming, adjust accordingly. Deepan mentioned that 2 years ago at a seminar, I said rates were going to go up. Now, this was October of 21, okay? I said that if we break, that channel is a 24-year channel. 24 years, it stayed, the rate stayed in that little river going down. Everybody see that? Okay. So I said, hey, if we break this channel, rates are going to go up sharply. When I said that, people thought I was crazy. The rates were 3.5. What are you saying, Gil? I'm saying we're going to adjust. Now, when that channel breaks, notice the next channel up, where it lands, in the 5s, that's where we're headed. This was in August 4th of 2022. We had an inflection point. I called all my agents. I emailed a bunch of agents, obviously Chris, and let them know, hey, we're at a 2.5 treasury. In the next month or two, we'll be at 4. Everybody thought I was nuts. Okay, I said, it's going to move, and it's going to move hard, and now. This is an email that I sent to everybody, okay? And I told everybody rates would go. I locked my portfolio. I called my clients. I said, you need to refi now. Let's lock it now. Let's not wait. What happened? Okay, so this is where we're at now, guys. So we broke that channel, didn't we? See that channel? It's broken, clearly broken. Now, you see the bottom, that first little arrow on the bottom, that was October 21st when I said rates were going to go up, okay? Did they go up? Then the next channel is the inflection point. That's when I send that email in August of 22. When I said, it's time to do locks now. We're headed up. We're headed to 4. Where did it go? 4. Now, what does 4 mean? A 4 treasury means that banks usually charge 2.5% or 3% over. So a 2.5% 4 treasury drove us from a rate of 5 to 6.5. Well, 3, because we hit it in October. Okay. So that being said, that's where this market's headed. Now, where are we headed and what's our future? Our future's at that top box, next target, minimum. Did you hear what I said? Minimum. We're headed to 5. So that means rates will be 7.5 to 8.
So what conclusions can we draw? Here's what I would say, end of third quarter 2023. That one should not be shocked by the findings. Again, the market was already on this trajectory. We had a little blip in the screen, 2020, 2021, some of 2022. And hopefully you made a lot of money during that time, made some right moves and put the right financing in place. But now we're on the other side of that. And quite frankly, interest rates have been tracking downwards for like 3 decades. And the other component of this is for about the last 3 to 4 decades, really everything has been in a landlord's favor. Property values, rental rates, vacancy rates declining. Politics really were obviously more in favor of the landlords. That pendulum now has swung. It's swung when it comes to the politics, obviously here locally, in the tenants' favor. Is it going to stay that way? Well, I guess you and I determine that by the way we vote. But at least for the time being, it looks as though things are only going to get stricter. There's only going to be more complexities to owning multifamily real estate. So you got to have the right strategy. You have to ensure that you have the right network of professionals to turn to that have the right information, whether it's with respect to the legalities of owning multifamily properties, the financing of owning your property, right? Do you have to refinance? What's going on with your current debt? That's a ticking time bomb. If your fixed rate is about to adjust, as Gil explained, that might be a ticking time bomb for you, greatly will impact the cash flow. Maybe we need an analysis there. We've discussed market trajectory to understand what's taking place. And so then, how do you build your financial legacy? What's next? What's the next step? Not doing nothing is an action. Inaction is an action. And I would say that that's maybe not the smartest action, right? We want to pivot to profits. We don't want to just survive. Survive would be, we put you in the corner, we put a blanket on you, we bring you 3 square meals a day, you're alive. That's surviving. That's not living, right? So we want to thrive. We want to thrive as multifamily investors. And it takes a winning strategy. Here we discuss the 3 pillars to a financial legacy. We'd be happy to discuss that with you. That has been time tested now to prove that regardless of market direction, regardless of what may be going in or taking place in the market, you follow these 3 specific pillars as we outline for our clients. It's a winning strategy regardless of what the current dynamics may be. If you have not, be sure to subscribe to our channel. Be sure to turn on alerts so you receive the videos as they're released. And in the coming days, weeks, months ahead, we're going to continue to share that information, the network of professionals, and the winning strategy that's going to greatly impact your financial legacy in multifamily properties. Share a comment. Let's engage with each other. Let us know, has this information that we've shared now over the last few years, specifically this video, is it helping you? Is it of some service to you? What else could we be discussing that would be of service to the local landlords? Please let us know. And Chris German from the Apartment Dealer wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.